Hi there. If you own a business in the UK, inheritance tax planning is crucial. In this video, we explain BPR changes and practical succession strategies every owner should understand.
Hello and welcome from all of us here at My Tax Accountant. We're a UK firm that's all about giving you clear, straightforward tax guidance. Today, we're diving into what are, frankly, the biggest inheritance tax changes for UK business owners in a generation. If you run a family business, you're going to want to pay close attention because what happens in the next couple of years could completely change your family's future. Let's get into it. So, let's just cut straight to the chase. From April 2026, there's a massive shift in tax law coming. And because of it, your family business could suddenly be on the hook for a tax bill it was never, ever designed to pay. And look, we're not talking small change here. For many, this could easily run into hundreds of thousands, maybe even millions of pounds. So just sitting back and hoping for the best, that's really not an option anymore.
So how are we going to break all this down? Well, we've split it into 5 clear parts. First up, we'll look at the lifeline that business owners have been counting on for decades. Then, we'll get into the details of the 2026 shakeup. After that, we'll walk through a case study so you can see the real-world impact. Then, and this is the important bit, we'll give you a toolkit of strategies you can use. And finally, we'll wrap it all up by talking about how to secure your family's legacy.
Right, let's start at the beginning with the absolute key to all of this, a tax relief called Business Property Relief, or BPR for short. You know, for decades, this has been the ultimate tax shield for family businesses. It's the very thing that's allowed them to pass from one generation to the next. So what exactly is BPR? Well, to put it simply, it's a form of inheritance tax relief that was specifically designed to stop successful family companies from being, well, destroyed by a massive tax bill when the owner dies. I mean, without it, so many families would be forced to sell the very business they'd spent a lifetime building just to pay HMRC. It's been the bedrock of succession planning for years.
And for a very long time, the most important word associated with BPR was unlimited. It truly was the cornerstone of succession planning. A qualifying business, didn't matter if it was worth £3 million or £30 million, could pass down to the next generation completely free of inheritance tax. But, as you've probably guessed, that cornerstone is about to crack.
And that brings us to the big tax shakeup. You see, on the 6th of April 2026, the era of unlimited relief comes to a very definite end. This date, you'll want to remember it, it marks a huge shift in how the UK taxes private businesses and family wealth.
So here's the change. It sounds simple, but the impact is enormous. We are moving away from that old world of unlimited 100% relief to a brand new reality, a cap. For the very first time, there is a hard limit on how much of your business's value can be fully shielded from inheritance tax. And here it is. This is the new magic number. The cap for 100% relief is now set at £2.5 million per person. And just to be clear, that's a combined allowance that covers both business and agricultural property relief. Anything above this value, well, that's going to be taxed very differently.
So what actually happens when your business assets go over that £2.5 million threshold? Well, instead of that lovely 100% relief, any value above the cap only gets 50% relief. Now, with the main IHT rate at 40%, this works out as an effective tax rate of 20% on that excess amount. The good news is the allowance is transferable between spouses, so a couple can shelter a combined £5 million. But there's a bit of a sting in the tail for investors in AIM-listed shares. From April 2026, they will only ever qualify for 50% relief, no matter what their value is.
Okay, so abstract numbers and percentages are one thing, but what does this actually mean for a real family business? Let's walk through a quick case study to see how these changes create a very real and very expensive problem.
Right, let's meet Alex and Priya. They're a married couple who spent their lives building a successful trading company. Their shares are now worth a cool £7 million. On top of that, they've got about £5 million in other personal assets. And, like so many entrepreneurs, their entire succession plan was built on that solid foundation of 100% unlimited BPR.
Okay, let's look at the numbers and their potential inheritance tax bill. Before April 2026, the entire £7 million of business shares would be fully relieved. That means zero tax on the business itself. The tax on their other assets would come to about $1.74 million. But after April 2026, that calculation changes big time. As a couple, their combined £5 million allowance gives them 100% relief on that portion. But the remaining $2 million in shares, that only gets 50% relief, creating a brand new $400,000 tax bill purely on the business. And that is the problem summed up in a single number. An extra £400,000 in tax has just appeared out of thin air. Not because the business changed, not because they did anything different, but simply because the law changed. Just think about what that means in the real world. For a business like theirs, 400 grand could be their entire R&D budget for a year, or the salaries for a handful of key staff. It's cash that their kids would somehow need to find, and it might even force them to sell off parts of the company they've just inherited. This is the new reality.
Okay, so that's the problem. It's a bit of a shocker, I know, but the big question now is, what on earth can you do about it? Well, this brings us to your new succession planning toolkit. The time between now and April 2026 is an absolutely critical window of opportunity, and there are several strategic moves you can make.
So, here are 5 key steps every single business owner should be thinking about right now. First, an urgent review of your will. It's crucial, as old clauses can now cause big tax problems. Second, you could consider some strategic lifetime gifting to reduce your estate's value before the new rules kick in. Third, trusts are still a powerful tool for freezing the value of assets. Fourth, it's really worth looking into modern structures like family investment companies. And finally, number 5, you absolutely need a clear plan to fund any leftover tax bill so your family isn't left in a panic.
And here's a professional tip from us and my tax accountant. Reviewing your will isn't just a good idea, it's absolutely essential. So many wills contain standard clauses that were written for the old era of unlimited BPR. For example, maybe it leaves business assets directly to the children, while other assets go to a spouse. Well, under the new rules, this could completely waste the spouse's BPR allowance and accidentally trigger a huge and entirely avoidable tax bill. You have got to make sure your legal documents are fit for purpose in this post-2026 world.
Now, one tool that we're seeing become much more popular is the Family Investment Company, or FIC. The easiest way to think of it is as a private company just for your family's wealth. It allows the older generation, so that's probably you, to keep control over the assets and the big decisions while you gradually pass the economic value and the growth to the next generation using different types of shares. In a world where trusts are facing more and more restrictions, FICs are a really powerful and flexible alternative for long-term wealth management.
And hey, did you know there are a few other big changes happening around the same time? From April 2027, the tax-free haven that pensions have been largely comes to an end, with most unused funds being pulled into your taxable estate. That's a big one. On a more positive note, the option to pay IHT on business assets over 10 annual installments is staying, which will certainly help with cash flow for your kids. And this is really key, that new $2.5 million BPR allowance is designed to refresh every 7 years, which opens up some really powerful long-term gifting strategies if you plan ahead. All of which brings us to our final section, securing your family's legacy. Look, the rules have definitely changed, but a successful, smooth succession is still 100% possible. The key thing to remember is that the window to plan for it effectively is right now.
This timeline really puts the urgency into sharp focus, doesn't it? We are in the final countdown. April 5th, 2026 is the very last day of the old rules. The next morning, the new caps are law. And just 1 year after that, pensions get pulled into the IHT net. Every day that goes by is a lost opportunity to plan under the current, much more generous system.
And really, this is the bottom line. For so many families, the cost of doing nothing could be genuinely devastating. It can mean watching a lifetime of hard work get chipped away by a tax bill that could have been reduced or maybe even avoided altogether. But with proactive, expert planning, you absolutely can protect the wealth you've worked so hard for.
So we'll leave you with one critical question to think about. When you look at your business, at your will, and at your family's future, is your succession plan truly ready for that 2026 deadline? Now, if your honest answer to that is I'm not sure, or if anything we've talked about today has raised some concerns, please just take the first step. Get in touch with us here at My Tax Accountant. Our team specializes in this exact area, succession planning for business owners, and we can give you the advice you need to navigate these changes. All the details are on the screen, and hey, while you're at it, please subscribe to our YouTube channel for more insights like this.
And finally, just the important disclaimer. The information in this explainer is for general guidance and was, of course, correct at the time we recorded it. But tax law is complicated, and everyone's personal circumstances are different. It is absolutely vital that no action is taken without seeking independent professional advice that is tailored to your specific situation. Thank you for watching.